Hey everyone, welcome back to Corporate Decoder. Today we're diving into a Form 8K filing from Eterna, exactly the cure for boredom, but it does involve a bit of debt. Let's see what kind of financial maneuvering they're up to. This report is basically a quick update that companies send to the Securities and Exchange Commission, or SEC, when something important happens that investors should know about. In this case, it's about a new loan. The main event happened on March 11, 2025. So what exactly happened then? Here's the core of the story. Eterna Therapeutics got a loan. It's called a promissory note and it's for a pretty significant amount of money. They issued a promissory note with an aggregate principal or initial amount of $1,500,000 to Charles Charrington. That's $1.5 million. The promissory note accrues interest at a rate of 5.0% per year, payable at maturity. So they need to pay back the loan plus 5% annual interest. This note is due on June 15, 2025, or if they get more than $5 million from selling stocks or convertible debt or warrants, or if something bad happens. When they make payments, it will first go to cover any outstanding fees or charges, then to cover the accrued interest, and finally, to reduce the principal amount of the loan. If they miss a payment, the interest rate jumps to 7% per year on the overdue amount. That gives an incentive to pay on time. They actually got the $1,500,000 already on March 11, 2025, so they have the cash in hand. There are some common events that will cause default on the loan, such as the company failing to pay money, or breaches of any representation or warranty, or failure to pay other debts in an amount above $50,000, and certain events of bankruptcy. If any of these events occur and continue, Charles Charrington can ask that all money be repaid immediately. This part just reiterates the main point. Eterna Therapeutics now has a direct financial obligation because of this loan. If you want to read the loan agreement, also called the promissory note, you can check out Exhibit 10 Fon. That's where you'll find all the details. So what does this all mean? Eterna Therapeutics needed $1.5 million and they got it in the form of a short-term loan with a moderate interest rate. The terms are pretty standard for this type of financing, but it does put some pressure on the company to either generate more capital quickly or repay the loan by June. If they can't, the interest rate will rise. This suggests that Eterna Therapeutics might be in a bit of a cash crunch. The good news is they secured the funding. The potential downside is that they now have a deadline to either find more substantial funding or start repaying this debt. Overall, the direction of Eterna Therapeutics seems to be focused on securing short-term financing to bridge gaps. A notable opportunity could be successful clinical trials or partnerships that lead to more substantial funding, but a major risk is their ability to manage and repay debt if they don't achieve revenue goals or secure more significant investment. In conclusion, this filing reveals that Eterna Therapeutics is navigating its financial needs through short-term borrowing, which can be a risky but necessary strategy for a company still finding its footing. Investors should watch closely to see how they manage this debt and whether they can secure more stable funding in the near future. Thanks for watching. If you found this breakdown helpful, please hit the like button, leave a comment, and subscribe for more insights into the world of corporate filings.